Statistically, 90% of retail traders lose money in the stock market. And that's probably because they don't understand basic terminology. It's like trying to perform surgery with a butter knife. Technically possible, but you're gonna hurt someone. If you want to stop being financial roadkill and actually make money instead of donating it to hedge funds, you need to speak the language. In today's video, you'll learn over 100 essential stock market terms that separate the wolves from the sheep. Before we dive into modern markets, though, we need to understand what came before. Stock exchanges started in the 1600s when Dutch merchants realized they could sell shares of risky ocean voyages to spread out losses. Smart move. Why lose all your money when you can lose just some of it? The stock market itself is just a giant marketplace where people buy and sell pieces of companies. Think of it like eBay, except instead of selling your old Pokemon cards, you're trading ownership stakes in Apple. A stock represents partial ownership in a company. Buy Amazon stock, and congratulations, you now own a microscopic piece of Jeff Bezos' empire. Your single share probably won't get you invited to the company barbecue, but hey, dreams are free. Shares are individual units of stock. It's like pizza slices. The company is the whole pizza. Shares are the slices. Except these slices can randomly become worth more or less for reasons that make astrology look scientific. Not all shares play by the same rules. Common stock gives you voting rights and a shot at dividends. Preferred stock is more like the VIP lounge. You get paid first, but you don't get a say in anything. It's the financial version of being important but ignored. Then comes the idea of float, the number of shares actually available for the public to trade. A low float stock can move faster than a Tesla on aggressive autopilot, and it can skid off the road just as dramatically. But how do these shares even reach the public? That happens through an IPO, an initial public offering. This is when a private company steps into the spotlight and sells its shares to the public for the first time. Think of it as a debutante ball, except with bankers, regulators, and absolutely no dancing. Once a company is publicly traded, its total value gets summed up by market capitalization. It's just share price multiplied by total shares outstanding. That number is basically the market's best guess of what the entire company is worth, fueled by millions of opinions, caffeine addictions, and hot takes. Understanding what stocks are is one thing. Understanding why they move is where the real mind game begins. Markets are driven by psychology, and investors love their animal metaphors. A bull market is when prices rise steadily. Bulls strike upward with their horns, so the metaphor stuck. A bear market is the opposite, where prices collapse and everything feels like it's being swatted down by a very annoyed grizzly. Whoever came up with these terms definitely spent too many weekends loitering near zoo enclosures. But markets aren't obedient creatures. They don't move in clean straight lines. A correction is a 10 to 20% drop. Basically, the market tapping you on the shoulder and reminding you that gravity is still around. A crash is when prices plunge more than 20% in a single day. That's when gravity stops tapping and starts throwing hands. Sometimes markets take a break from all this drama through consolidation, when prices move sideways like your portfolio during a Netflix binge. Lots of time passing, nothing really happening. Within these broader movements, individual stocks face their own psychological barriers. Resistance levels are prices where stocks struggle to break higher. Support levels are where they stop falling. Think of them as the floor and ceiling of your financial apartment. Hopefully, the ceiling is higher than the floor. You can spot these psychological moments by watching volume. How many shares are traded? High volume usually means something important is happening, either really good news or someone's about to lose their retirement fund. All this psychology plays out through actual trades, and that's where market mechanics get interesting. Every trade has two sides: the bid, the highest price someone's willing to pay, and the ask, the lowest price someone's willing to sell. The difference is called the spread, and it's basically the market's way of charging you for the privilege of trading. Facilitating all these trades are market makers, the middlemen who always stand ready to buy or sell. They're like the friend who's always available to hang out, except they make money off your loneliness. Some clever traders exploit price differences through arbitrage, buying something cheap in one place and selling it expensive somewhere else. It's basically the stock market version of buying concert tickets and scalping them, but legal. Now that you understand the mechanics, let's talk about how to actually place trades. Market orders execute immediately at current prices. Limit orders only execute at your specified price or better. Market orders are like ordering whatever's hot at a restaurant. You might love it, or you might get yesterday's fish. When things go wrong, you'll want stop-loss orders that automatically sell when prices hit your pain threshold. They're like ejector seats for your portfolio. Hopefully you never need them, but you'll be glad they're there. Let's get more sophisticated. Stop limit orders combine stop-loss with limit orders. Good till canceled orders stay active until you cancel them or they expire. Fill or kill orders execute completely or not at all. No participation trophies here. For the perfectionists, all or none orders require the entire order to be filled. Immediate or cancel orders fill whatever they can right away and cancel the rest. It's like speed dating for stock orders. I know these terms are confusing, so why not learn different ways to lose money? Armed with these order types, traders employ various strategies. Day trading means buying and selling stocks within the same day. It's essentially gambling with extra steps and a Bloomberg terminal. Most day traders would have better odds at a casino, but at least casinos serve free drinks. Swing trading involves holding positions for days or weeks. It's like day trading's slightly more responsible cousin, who still makes questionable life choices. For the truly hyperactive, scalping means making tiny profits on small price movements throughout the day. It's death by 1,000 paper cuts, but in reverse, hopefully. On the opposite end, position trading involves holding stocks for months or years. It's the marathon approach to investing, requiring patience most people don't possess. Momentum trading involves buying stocks that are moving and hoping they keep moving. It's like jumping on a moving train, thrilling when it works, painful when it doesn't. Then there's contrarian investing, doing the opposite of everyone else. When people are greedy, you're fearful. When they're fearful, you're probably also fearful because humans are bad at this. Speaking of fun new ways to supercharge your mistakes, welcome to the world of options. These are financial contracts that give you the right, not the obligation, to buy or sell a stock at a specific price. Options can make you rich, humble you, or teach you entire semesters of risk management in a single afternoon. A call option is basically you betting the stock price will rise. A put option is you betting it'll fall. If you're wrong, your option expires worthless. Kind of like my college degree, except this one evaporates even faster. The strike price is the level at which you can exercise the option. The expiration date is the day your contract dies, ideally after earning you money, not sympathy. In the money options have real value baked into them. Out of the money options are lottery tickets with better branding and worse odds, yet somehow people love them anyway. Options get messy surprisingly fast thanks to something called time decay, also known as Theta. This is how an option slowly loses value as expiration approaches. It's financial ice cream. No matter how careful you are, it melts, and usually onto your shoes. Then there's implied volatility, the market's prediction of how wildly a stock might swing. High IV makes options more expensive and increases the odds that your brilliant idea becomes an expensive memory. For the mathematically adventurous, we have the Greeks, delta, gamma, theta, vega, and their extended family. These measure how sensitive your option is to price changes, volatility, and time. Think of them as the heartbeat, blood pressure, and oxygen level of your options trade. On the gentler end of the chaos spectrum, there are conservative strategies like covered calls, selling call options on stocks you already own, and cash-secured puts, selling put options with enough cash set aside to buy the shares if needed. Both are technically safer, but still perfectly capable of separating you from your money with elegance. Not everyone bets on success. Short selling involves betting against a stock by borrowing shares, selling them, then hoping to buy them back cheaper. It's legally sanctioned pessimism with unlimited loss potential. What could go wrong? To amplify both gains and losses, traders use margin, borrowing money to buy more stocks. It's leverage that can turn small mistakes into spectacular failures. The market has a sense of humor, and margin calls are the punchline. Margin calls happen when your account value drops below maintenance requirements. It's like your broker saying, pay up or we're taking your stuff. If you want to day trade seriously, pattern day trader rules require $25,000 minimum to trade freely. It's the market's way of making sure you have enough money to lose properly. Individual stocks are pure chaos, like trying to predict the mood swings of thousands of strangers. Indices, however, offer a bit of structure to the madness. The S&P 500 tracks 500 large U.S. companies and acts like a corporate popularity contest, weighted by how much each company is worth. The bigger the company, the bigger its vote in the index. The Dow Jones follows 30 blue-chip giants, but uses a completely different weighting system, one that somehow survived from the 1800s. The Nasdaq, meanwhile, is the tech-heavy cousin that tends to throw the wildest parties. Each index tells its own version of the market's mood. For smaller companies, there's the Russell 2000, the heartbeat of small-cap America. And when fear takes over, the VIX steps into the spotlight. It measures market anxiety. When it's high, everyone's already panicking. When it's low, it usually means the panic just hasn't started yet. Instead of juggling individual stocks like flaming torches, you can invest in baskets of them through different vehicles. Index funds let you own tiny slices of hundreds of companies at once. It's diversification for the strategically lazy. And honestly, laziness might be one of the most underrated investment philosophies ever invented. Then there are ETFs, or exchange-traded funds, index funds with better mobility. They trade like stocks, come in thousands of flavors, and function like the Swiss Army knife of investing. Versatile, practical, and far less likely to injure you. Mutual funds are professionally managed pools, where you hand your money to experts who promise to lose it with greater precision than you ever could. Sometimes they outperform. Other times they simply outperform your expectations of disappointment. For those with deep pockets, hedge funds are exclusive investment clubs, armed with complex strategies the average investor can't touch. Occasionally they mint fortunes. Occasionally they detonate and instantly become Netflix content. If you want exposure to real estate without the joys of broken plumbing and angry midnight phone calls, real estate investment trusts offer property ownership without the landlord nightmares. You get the income, they get the headaches. Not all stocks are created equal. Blue chip stocks belong to large, stable companies. They're the comfort food of investing. They won't thrill you, but they probably won't poison your portfolio either. Growth stocks are companies expected to expand faster than the pack, while value stocks are the supposedly underpriced gems everyone believes they discovered first. Both approaches work until they suddenly don't. Company size matters too. Small cap, mid cap, and large cap simply describe a company's market value. Small caps are ambitious startups with more dreams than revenue. Large caps are established giants. Mid caps exist in that awkward teenage phase, grown enough to be noticed, not grown enough to be trusted. Then there are penny stocks trading under $5. They're cheap for a reason, usually involving dubious business models and accounting practices that require imagination more than math. Some stocks move with the economy itself. Cyclical stocks rise and fall with economic cycles, riding every boom and suffering every bust. Defensive stocks supposedly hold up better during downturns. But defensive becomes a flexible word when the entire market is on fire. Speaking of getting paid, let's talk dividends. Those lovely cash payments companies send to shareholders. It's basically money for existing. Imagine your car mailing you a check every quarter just for sitting in the garage. That's the dream dividends are selling. The dividend yield tells you how much you earn in dividends each year relative to the stock's price. The payout ratio shows what portion of a company's earnings goes toward dividends instead of being reinvested. Too high can mean the company is overly generous. Too low can mean they're hoarding cash like a dragon. Companies occasionally like to shake the snow globe with corporate actions. A stock split increases the number of shares while lowering the price proportionally. It's like slicing a pizza into more pieces. You don't get more pizza, just more triangles to admire. Sometimes instead of handing out cash, companies pay stock dividends, giving shareholders additional shares. Special dividends are one-time cash payouts, usually because the company has too much money lying around, a problem the rest of us can only aspire to. A spin-off happens when a company breaks off a division and turns it into a brand new standalone business. Mergers and acquisitions mash companies together, often with the same long-term success rate as celebrity relationships. Rights offerings give existing shareholders the chance to buy more shares at a discount. And warrants are like long-term options issued by the company itself. Little IOUs saying, "Buy us later, maybe we'll be worth more." Figuring out whether a stock is worth buying means diving into valuation metrics, the financial equivalent of checking under the hood before buying a used car. The PE ratio compares a company's price to its earnings. A high PE might mean the stock is wildly overvalued or that you've stumbled onto the next Tesla. Statistically speaking, it's usually the first one. The price-to-book ratio compares a company's market value to its accounting value. and price to sales compares market cap to revenue. These numbers help you decide whether a stock is genuinely expensive or just giving off expensive vibes. Return on equity shows how efficiently a company uses shareholder money. Return on assets measures how well it uses its actual assets to generate profit. Both tell you whether management knows what it's doing or is simply winging it. The debt-to-equity ratio reveals how much a company relies on borrowed money. High debt can be rocket fuel, or the reason everything explodes. For short-term stability, current ratio and quick ratio measure the company's ability to pay its bills. And cash flow tracks actual money moving in and out, because profit on paper doesn't pay rent in the real world. There's also forward PE, which uses projected future earnings instead of historical ones. The PEG ratio, which adjusts PE for growth expectations. And enterprise value, which factors debt into total company valuation, because debt is always someone else's problem until the day it lands in your lap. While fundamental analysts study companies, technical analysts study charts, the financial equivalent of reading tea leaves, but with more math and fewer herbs. Volatility measures how wildly a stock's price swings. High volatility stocks are like dating someone with commitment issues, exhilarating, unpredictable, and rarely a stable long-term plan. Moving averages smooth out price data over time. A simple moving average is just basic arithmetic. An exponential moving average gives more weight to recent prices, because apparently yesterday's drama matters more than last week's. Some of the most popular indicators include MACD, Moving Average Convergence Divergence, which tracks momentum shifts, and RSI, Relative Strength Index, which tries to measure whether a stock is overbought or oversold. Markets, however, have a long track record of ignoring these signals and staying irrational long enough to bankrupt anyone who believes otherwise. Bollinger Bands create price channels around moving averages, while Fibonacci retracements use ancient ratios to predict support and resistance levels, proof that medieval math occasionally moonlights as market wisdom. Candlestick patterns come with dramatic names like doji, hammer, and hanging man. They sound like martial arts moves, but supposedly offer clues about market direction. Chart patterns tell bigger stories. Head and shoulders patterns suggest trend reversals. Double tops and double bottoms are exactly what they sound like, and roughly twice as unreliable as their names imply. Modern markets look sleek on the surface, but underneath, they're a tangle of rules, technology, and controlled chaos. The SEC, the Securities and Exchange Commission, is basically Wall Street's hall monitor, tasked with preventing everyone from blowing up the financial system. It's a noble mission with the difficulty level set to impossible. FINRA regulates brokers and investment advisors. Picture them as the market's strict parents, checking your homework, enforcing curfews, and making sure no one cheats on the group project. Behind the scenes lurk dark pools, private exchanges where big investors trade massive orders without tipping off the public. It's like a restaurant with a secret menu, except the secret is how much money someone might quietly siphon away. Then we have high-frequency trading, where algorithms battle each other by firing off thousands of trades per second. It's essentially robot warfare, with your retirement fund wandering somewhere in the battlefield. And if you've ever wondered how free trading apps stay in business, the answer is payment for order flow. Instead of charging you directly, they sell your order information to market makers. You're not the customer in this arrangement. You're the product. Understanding market structure helps explain why investors behave the way they do. Liquidity measures how easily you can buy or sell a stock without moving its price. High liquidity stocks are like popular nightclubs, easy to get in, easy to get out. Low liquidity stocks are more like ultra-exclusive restaurants with month-long waiting lists. By the time you get a seat, you might regret the reservation. This psychology creates market traps. A bear trap happens when a stock looks like it's about to collapse, tempting short sellers, only for it to rocket upward and snap them in half. That's financial whiplash. A bull trap is the reverse. Stocks pretend to rally, luring in enthusiastic buyers, then crash and leave them as involuntary long-term investors. Modern investor behavior even has its own vocabulary. FOMO, fear of missing out, pushes people to buy at the top. FUD, fear, uncertainty, and doubt, convinces them to sell at the bottom. Emotional investing is basically drunk texting with your money. It feels brilliant in the moment and tragic the next day. A dead cat bounce is a brief recovery after a major crash. Even a dead cat will bounce if dropped from high enough. That's physics, not market optimism. Social media added its own mythology. A bag holder is someone stuck clinging to losing stocks. Diamond hands means holding through brutal volatility. Paper hands describe selling at the first sign of trouble. These terms were born on Reddit, which makes perfect sense if you've ever spent more than 5 minutes on Reddit. The internet rewired the entire market. After-hours trading happens when the regular exchanges shut down. It's the speakeasy of stock trading. Fewer people, more volatility, and a higher chance you'll regret whatever you did in the morning. Pre-market trading is the early bird version of the same chaos, and extended hours simply means both sessions wrapped together. Social media then gave birth to meme stocks, companies that surge not because of fundamentals, but because strangers on the internet collectively decide today is their day. Proof that the internet can move markets, though whether it should is another question entirely. This online frenzy created new market phenomena. A short squeeze happens when short sellers panic buy to close positions, sending prices skyrocketing. A gamma squeeze is the options market version, where market makers are forced to buy shares to hedge. Basically, a short squeeze with extra Greek seasoning. A SPAC, Special Purpose Acquisition Company, is a blank check shell that merges with a private business. Buying into one is like purchasing a mystery box. Sometimes there's treasure, sometimes it's empty, and sometimes it contains a company-sized headache. Technology also introduced robo-advisors, algorithmic portfolio managers that never sleep, never panic, and never try to upsell you terrible products. In other words, the exact opposite of human financial advisors. With all these creative ways to lose money, risk management becomes essential. Insider trading, using non-public information to trade, is illegal and can earn you an all-expenses-paid trip to prison. Martha Stewart found this out the hard way. Learn from her success, not her sentencing. Circuit breakers halt trading when markets crash too quickly. They're basically Wall Street's timeout corner, giving everyone a few minutes to breathe, hydrate, and reconsider their terrible decisions. Position sizing determines how much to risk on each trade, and the risk-reward ratio compares your potential loss to your potential gain. Diversification means spreading your investments around, so one mistake doesn't wipe you out. Correlation measures how similarly assets move. True diversification is surprisingly difficult, because when panic hits, everything tends to crash together in perfect harmony. Beta measures how much a stock moves relative to the overall market. High beta is the roller coaster. Low beta is the children's ride. Pick whichever adventure your stomach can handle. Alpha represents returns above the market. Generating consistent alpha is so rare that most active managers fail at it, which is exactly why index funds keep winning, one quiet, embarrassingly simple year at a time. Now let's wander into the wild side of finance. The concept's so strange, so counterintuitive, and so wonderfully absurd that dropping them into any conversation instantly makes you sound smarter than you feel. These aren't just ideas, they're conversation weapons. Use responsibly. So the stock market crashes and trillions of dollars just vanish. But money can't disappear into the void, right? Where does it actually go? The answer is, it doesn't go anywhere, because most of it was never really there to begin with. Think of it like this. You buy a Picasso for $1 million because that's what everyone agrees it's worth. Tomorrow, art critics decide abstract art is overrated and collectors will only pay $500,000. Where did your other $500,000 go? Nowhere. Same painting, same wall, but the collective agreement about its value just shifted. No money changed hands. The wealth simply evaporated when opinions changed. Most of the money in your portfolio isn't actually money at all. It's paper wealth, the theoretical value of what you own based on recent trading prices. When Tesla stock goes up 10% and Elon is suddenly $20 billion richer on paper, he didn't get a PayPal notification for $20 billion. His shares are just theoretically worth more based on what the last few traders were willing to pay. But here's the catch. That valuation only holds if you can find someone willing to pay that price. And during a crash, good luck with that. This is why market crashes hurt so much. When everyone panics and tries to sell simultaneously, there aren't enough buyers at current prices. It's like musical chairs, but instead of chairs vanishing, the people ready to buy your stocks are gone. Prices crash because supply suddenly overwhelms demand. The shared agreement about what things are worth breaks down, and everyone realizes the emperor has no clothes, or at least fewer clothes than we thought. Some real cash does move around during a crash. Investors who sold early and moved to cash locked in their gains before the drop. Those scooping up stocks at rock-bottom prices are putting real money on the line, betting the market will recover. In the end, the only real wealth transfer is from panicked sellers to patient buyers. and from over-leveraged traders to their creditors when margin calls come due. The Federal Reserve understands this dynamic. When crashes happen, they don't just shrug and say, well, those trillions are gone forever. They inject fresh liquidity into the system, essentially providing the cash that makes it easier for buyers and sellers to find each other again. They're not replacing lost money because that money was never physically lost. They're providing the confidence and liquidity needed for the collective agreement about asset values to stabilize and rebuild.
Like what? What?
Here's what this means. Most wealth in modern markets exists only as long as we collectively believe it should. Your house value, your retirement account, even the dollar in your wallet. They're worth what they're worth because we all agree they should be. This isn't some conspiracy or flaw in the system. It's actually how all value works in human societies. But it does mean that when confidence breaks down during a crash, enormous paper wealth can vanish almost instantly. Now, before you dismiss this as just numbers on a screen, remember that paper wealth has real consequences. It affects retirement plans, college funds, business investments, and economic confidence. When people feel poorer, they spend less, which affects actual jobs and real paychecks. So next time your portfolio crashes, remember, your money didn't vanish. It just moved to someone who was less panicked than you. Negative interest rates, when your bank literally pays you to borrow money but charges you to save it. It's like getting paid to eat pizza while being fined for going to the gym. Yes, this actually exists, and yes, it means the economy has officially lost its mind. So why would any central banker deliberately break the most basic law of finance? Simple, desperation. Well, when your economy is flatlining harder than a Windows 95 computer running Chrome and traditional tools have about as much effect as a chocolate teapot, desperate times call for desperate measures. Think of it as economic defibrillation. Sometimes you need to shock the system back to life. Here's the play-by-play. The economy tanks so badly that even cutting interest rates to zero does nothing. People are hoarding cash, businesses aren't investing, and everyone's basically playing financial hide-and-seek with their money. So the central bank goes full mad scientist and shoves rates below zero, making it literally cost money just to save. The logic is beautifully chaotic. Punish saving, reward spending. Banks get charged for stashing excess cash at the central bank, which in theory pushes them to lend more. Meanwhile, consumers are nudged to stop hoarding and finally buy that overpriced espresso machine they've been eyeing. It's less about encouraging responsible finance and more about bribing everyone into economic activity. Now let's look at some real-world carnage. The European Central Bank went negative in 2014 and kept rates at minus 0.5% for years. The result? German savers literally started buying home safes because paying a couple $100 for a steel box was cheaper than paying the bank to hold their money. Switzerland took it even further with rates at minus 0.75%, making it cheaper to borrow Swiss francs than to save them. And Japan? They've been stuck in this financial twilight zone since 2016, where mortgage rates can actually go negative. Yes, the bank pays you to buy a house. Sounds amazing until you realize your savings are evaporating faster than water on Mars. And your pension fund manager is basically one bad quarter away from a nervous breakdown. But does this financial wizardry actually work? Well, kinda. The Eurozone did see some recovery, but whether that was because of negative rates or in spite of them is about as clear as mud. What we do know is that it inflated massive asset bubbles, crushed pension funds, and made insurance companies wonder why they even exist. The unintended consequences read like a financial horror story. Banks saw their profit margins squeeze thinner than printer paper, which pushed them into riskier lending. Savers were punished for being responsible, while speculators got rewarded for gambling. And then there were the zombie companies, businesses that should have died years ago, but kept shambling along on cheap loans, clogging up the economy like financial undead. So what should you do if negative rates ever hit your country? First off, don't panic buy a mattress to stuff with cash. That's exactly the chaos central banks are trying to avoid. Instead, look at real assets like property or stocks. But don't go full YOLO. Diversify across currencies and consider things like I-bonds or TIPS that hedge against inflation. And hey, maybe pick up a recession-proof skill, like fixing things. Because when money gets weird, the economy does too. The bottom line? Negative interest rates are like performing surgery with a chainsaw. Sure, they might shock the patient back to life, but there's going to be a mess to clean up afterward. Wall Street figured out how to turn your death into a tradable asset. I'm not kidding. There are investors right now calculating how much money they'll make when you stop breathing. Introducing death bonds, the only investment backed by your grandma's expiration date. Here's how this morbid financial instrument works. Someone with a terminal illness sells their life insurance policy for cash. A company buys it, pays the premiums, then waits for the person to die to collect the full payout. But Wall Street wasn't satisfied with this simple transaction, so they decided to securitize it. Death bonds bundle hundreds of these life insurance policies together, package them into bonds, and sell them to investors. It's like mortgage-backed securities, except instead of betting on house prices, you're betting on how quickly people die. The math is straightforward. If someone dies earlier than expected, investors make money. If they live longer, returns go down. Your portfolio literally depends on other people's life expectancy. This market emerged from the AIDS crisis in the 1980s, when terminally ill patients needed cash for expensive treatments. They sold their life insurance policies in what's called viatical settlements. It actually served a real purpose back then. But like everything on Wall Street, what started as helping sick people pay medical bills eventually became a tradable asset class, because apparently betting on housing markets and commodities wasn't dark enough. The pitch to investors is pretty compelling, though. Death bonds offer high yields that aren't correlated to stock markets or interest rates. They're backed by the one certainty in life.
The bitch is dead.
The income is tax-free because life insurance payouts aren't taxed, and they even add portfolio diversification. But here's where things get dark. The industry is almost completely unregulated. Basically, anyone can set up shop and start trading death policies. There's little oversight on how these deals are structured or marketed. Critics even compare death bonds to the infamous collateralized debt obligations that fueled the 2008 financial crisis. Both take risky assets, bundle them up, sell them to investors who don't fully understand the risks and hope the math holds up. The returns aren't even that great. Sure, they beat treasury bonds, but they lag behind stocks. So you're taking on a morally sketchy investment for pretty mediocre gains. And here's where it gets truly twisted. Investment firms now actively hunt for sick people to buy policies from. Entire companies are built on tracking down the terminally ill, offering them quick cash, and then turning their deaths into Wall Street products. It's capitalism at its most ruthless, profiting off desperation, medical debt, and mortality itself. The market for death bonds peaked around $50 billion before the 2008 crisis. It's smaller today, but it never went away. Somewhere right now, a hedge fund manager is literally calculating whether your grandmother's cancer diagnosis makes her a good investment. This isn't just about making money from tragedy. It's about how financial markets will commoditize literally anything if there's profit involved. We've gone from trading corn and oil to trading human mortality. The fact that this market exists at all says something pretty dark about our economic system. When Wall Street runs out of things to securitize, apparently the next logical step is packaging people's deaths. This has been your reminder that somewhere in the financial system, someone is betting against your life expectancy. And that brings us to the end of this comprehensive crash course in market terminology. Master these 100+ concepts and you'll at least sound smart when you inevitably lose money like everyone else. The difference now is you'll understand exactly how you lost it. Knowledge is pain, but it's elegant pain. Remember, the stock market is a giant wealth transfer machine. From the impatient to the patient, from the emotional to the rational, and from people who don't understand these terms to the people who absolutely do. I'm your host, Mr. X-Banker, and I'll see you in the next video, ideally with your portfolio still intact and your dignity only mildly bruised.